Does thinking about money keep you up at night? You know the feeling I'm talking about. It's that knot in your stomach when you open your brokerage app and stare at a chart that looks less like a financial plan and more like a roller coaster at Six Flags. Up, down, loop-de-loop, and suddenly a steep drop that leaves you breathless. Everywhere you turn, there's a new headline screaming about an impending recession, or a YouTuber claiming this specific crypto coin is the future, only to watch it crash 40% the next day.
Maybe you've been burned before. You took a hot tip from a coworker, or maybe a brother-in-law who swore he knew a guy, and you watched hard-earned savings evaporate into thin air. It hurts. And honestly, it's confusing. If the stock market feels like a casino to you, that's because the way most people play it, it is a casino. They're not investing, they're gambling. They're betting on red or black, hoping the little ball lands in their favor before the house takes its cut. But here is the truth. You are not alone in this chaos. Most of the world is stuck on this same ride, terrified of the next turn. But what if I told you there is a way to get off the roller coaster? A calm, proven method to navigate this storm. A strategy used by a man who doesn't treat the market like a slot machine, but like a business. I'm talking about the Oracle of Omaha, Warren Buffett.
Welcome to The Last Read, books for your ears, wisdom for your life. Before we unlock the vault of the Oracle, I want to invite you to subscribe now. Make sure you never miss a lesson in wealth. Today, we are dissecting a financial classic, Buffettology, by Mary Buffett and David Clark. And for the scholars among you who want to study the charts and tables yourself, you can find the link to the hard book right there in the description.
But let's set the stage, because we aren't just talking about picking stocks here. If you think this is about reading ticker tapes or guessing which tech company is going to the moon next week, think again. We are talking about a fundamental shift in how you view the world of business. We are going to move from a gambler's mentality to a business owner's mentality. Over the next few episodes, we are going to tease out the secret sauce that separates the winners from the losers. We will explore the concept of the consumer monopoly, the type of business that has a toll bridge on the consumer's mind, versus the commodity businesses that fight tooth and nail just to survive. We are going to walk through the math of wealth, not the complex calculus of Wall Street, but the simple compounding logic that Buffett used to build an empire.
I promise you, by the end of this series, you will look at a price tag completely differently. Whether you are walking down the aisle of a grocery store or looking at a P&L statement, you won't just see a cost, you will see value. But before we get into the numbers, we need to understand the source. How do we know this isn't just another theory from the outside looking in?
Well, the answer lies in the people who actually wrote the words. This isn't just another academic study from a distance. This is a playbook written by someone who passed the mashed potatoes to the Oracle himself. Enter Mary Buffett. For 12 years, Mary was married to Warren's son, Peter. She wasn't an outsider looking in, she was family. She had a front row seat to the master's thinking, not in a stuffy boardroom, but at the dining room table during Thanksgiving turkey and Christmas quiet.
She didn't just read about Warren's philosophy, she lived it. She tells stories of how Warren used to give $10,000 in cash to family members for Christmas. But when he realized they were just spending it, he switched to giving them stock in companies he had recently bought. He turned holiday gifts into lessons on compounding interest. While others might have just cashed out, Mary paid attention. She listened to the logic behind the gift and the rationale behind the purchase. But anecdotes alone don't build a portfolio. You need the math to back it up. That is where David Clark comes in.
David is a portfolio manager, an attorney, and a man often described as the world's leading Buffettologist. He grew up in Omaha with the Buffett children and spent decades reverse engineering Warren's methods with the precision of a forensic accountant.
While Mary provided the access and the intuitive wisdom gained over family meals, David brought the calculator. This collaboration is what makes Buffettology unique on the shelf. It is the perfect marriage of intimate family access and rigorous financial dissection. It isn't just theory, it is the convergence of the why and the how. And because we are working from the inside out, we have to start where Warren starts. We have to abandon the way most of the world looks at the stock market and adopt a completely different perspective.
So, what is this completely different perspective? It is a concept that sounds incredibly simple, yet it is the single hardest hurdle for most investors to clear. In the book, Mary and David refer to it as business perspective investing. See, most people, when they log into their brokerage app or watch the financial news, they don't see companies, they see ticker symbols. They see AAPL or KO or MCD. They see a jagged line moving up or down, and they view that stock certificate as a piece of paper to be traded. They buy it at $20, hoping to sell it at $25. It's a transaction, a wager on mass psychology. Warren Buffett does not play that game. When Warren buys a share of stock, he views it exactly the same way as if he were buying the entire company. He isn't buying a ticker symbol. He is buying a living, breathing business. Let's bring this down to a level we can all feel. Imagine for a moment that you decide to buy a local business. Let's say you save up and you buy a McDonald's franchise right there in your town. You sign the papers, you get the keys, and you are now the owner.
Now, ask yourself this. Would you call a real estate broker every single hour to ask, "Hey, what is my store worth right now? Did the value go up since lunch? What about now?" Of course not. That would be absurd. You wouldn't care what the momentary resale value of the building is. You would care about the business. You would look at the cash register. You would want to know how many Big Macs you sold today, how much you spent on potatoes, and what your profit margin was at the end of the shift. If the store is profitable and the profits are growing, you know the value of your investment is going up, regardless of what a broker says on any given Tuesday. That is business perspective investing. As David Clark explains in the book, you have to stop looking at the price of the stock and start looking at the performance of the company. There is a famous litmus test that Buffett uses, and it is mentioned often when discussing this philosophy. He says you should only buy a stock if you would be perfectly happy holding it if the market closed down for 5 years. Just imagine that. The New York Stock Exchange shuts its doors. No ticker tape, no price quotes, no way to sell.
If you are a speculator, that is your worst nightmare. You are trapped. But if you are a true investor, if you think like a business owner, it doesn't bother you at all. Why? Because your McDonald's is still selling burgers, your business is still earning money, and eventually, those earnings will find their way back to you. However, this perspective only works if you pick the right kind of business. You can't just buy any old shop and hope for the best. If you buy a business that struggles to make a profit, or one that has to fight tooth and nail for every single customer, holding it for 5 years might actually destroy your wealth. So, we know we need to think like owners, but what kind of business should we own? Warren isn't looking for just any profitable company. He is hunting for a very specific economic structure. He is looking for a company that doesn't just compete, but dominates. He is looking for a business that acts like a toll bridge, one that the customer has no choice but to cross.
That toll bridge concept is what Mary Buffett and David Clark call a consumer monopoly. And to really understand why it's so powerful, we first have to look at its evil twin, the commodity business. Think about airlines or gas stations. If you're driving down the highway and you see 2 gas stations side by side, and one is selling gas for $3.50 and the other is selling it for $3.55, which one do you go to? You go to the cheaper one. Why? Because gas is gas. You don't care about the brand, you care about the price. That is a commodity business. They have to fight tooth and nail for every customer, and usually the only way they can compete is by lowering their prices, which destroys their profit margins. Now, picture the opposite. Picture a business that acts like a toll bridge. If you want to cross the river, you have to pay the toll. There is no other bridge for 50 miles. You can't just shop around for a cheaper bridge.
Warren loves this structure, and he usually finds it in companies that own a piece of the consumer's mind. Take Coca-Cola, for example. If the price of a generic store brand cola goes up, you might switch to a different cheap brand. But if the price of a Coke goes up, you probably still buy the Coke. It's not just brown sugar water, it's a specific taste, a specific feeling. You don't want the cheaper version, you want the real thing. Or think about Gillette. Warren has famously said he sleeps better at night knowing that millions of men around the world are shaving and that their beards are growing while he sleeps. When you find a razor you like, you tend to stick with it. You aren't checking the price of razor blades every morning to save 3 cents. You are loyal to the brand.
This loyalty creates something magical called pricing power. In fact, Warren says this is the single most important decision in evaluating a business. He puts it this way: if you can raise your prices without losing business to a competitor, you have a very good business. But if you have to have a prayer session before raising the price by 10%, then you've got a terrible business. This ability to raise prices is the secret engine of wealth, especially when inflation hits. While the commodity business is getting crushed by rising costs, the consumer monopoly just raises its toll, and we keep paying it. So, before we look at the financials, I want you to ask yourself a question. Look around your house. What product do you use that you would buy even if the price doubled? If you can find a product like that, you might have just found a consumer monopoly. But here is the catch. You can't just rely on your gut feeling about a brand. You need proof. You need to see if that monopoly status is actually showing up in the bank account. To do that, we have to pop the hood and look at the engine, specifically 2 numbers that tell us if the machine is running efficiently. So, before we look at the financials, I want you to ask yourself a question. Look around your house. What product do you use that you would buy even if the price doubled? If you can find a product like that, you might have just found a consumer monopoly. But here is the catch. You can't just rely on your gut feeling about a brand. You need proof. You need to see if that monopoly status is actually showing up in the bank account. To do that, we have to pop the hood and look at the engine, specifically 2 numbers that tell us if the machine is running efficiently. The first number, and probably the most critical one in the entire Buffettology system, is return on equity, or ROE. It sounds technical, but it is actually just a simple measure of efficiency. Think of it this way. Imagine you have a machine sitting in your basement. You feed $100 into the top of that machine. At the end of the year, the machine spits out $20 in profit. That is a 20% return on equity. Now, imagine your neighbor has a different machine. He feeds in the same $100, but his machine only spits out $2. That is a 2% return. Which machine would you rather own? Obviously, the first one. You want the machine that works harder for every dollar you put inside it.
Warren Buffett is looking for that first machine. He wants companies that consistently generate high returns on the money shareholders leave in the business. In the book, Mary Buffett and David Clark suggest looking for an ROE of 15% or higher, year after year. Consistency is key here. If the number jumps up and down like a yo-yo, it's not a reliable engine. But 1 year of good returns isn't enough. Anyone can get lucky once. That brings us to the second number, earnings per share, or EPS. We are looking for a track record here. You want to pull up the numbers for the last 10 years. You don't just want to see positive earnings, you want to see an upward trajectory. It should look like a staircase going up. If the earnings per share are climbing steadily, it means the company's consumer monopoly is getting stronger. It proves that the brand power we talked about earlier is actually translating into cold, hard cash. However, there is a trap, and this is where most amateur investors get burned. A company can sometimes fake a high return on equity. They can make the machine look efficient by cheating. How do they do it? Debt.
If you borrow a massive amount of money to juice your returns, your ROE looks fantastic on paper, but it's risky. Think of it like 2 families living on your street.
Family A earns a modest income, but they have zero debt. They live within their means. Family B drives luxury cars, goes on expensive vacations, but they are drowning in credit card bills. When the economy is booming, Family B looks like they are winning. But when a recession hits, when the financial winter comes, which family survives? Family A sleeps soundly. Family B loses the house. Buffett wants to invest in Family A. He loves companies with little to no long-term debt. A good rule of thumb from the book is that a company should be able to pay off all its long-term debt with less than 3 or 4 years of net earnings. If they can't do that, they are living on borrowed time. So let's say you've done the work. You found a company with a high return on equity, growing earnings per share, and zero debt. You have found the perfect engine. Does that mean you should go out and buy the stock immediately? Not quite. Just because a Ferrari is a great car doesn't mean you should pay $10 million for it. Even the best business can be a terrible investment if you pay the wrong price. And determining that price involves ignoring a very loud, very emotional character known as Mr. Market. We'll meet him in a moment.
Meet Mr. Market. He is a creation of Warren's mentor, Benjamin Graham, but he is the central character in the Buffettology philosophy of price. Imagine you own a house, a nice, solid house, and imagine you have a business partner named Mr. Market. Every single day, Mr. Market knocks on your door and offers to buy your share of the house or sell you his. The problem is, Mr. Market is manic depressive. He is emotionally unstable. Some days he wakes up euphoric. He sees only sunshine and rainbows. He bangs on your door and shouts, "I'll give you $1 million for your half of the house." Now you know the house is only worth $200,000, but he's frantic to buy. Other days, he is deeply depressed. He sees nothing but rain and ruin. He knocks on your door, weeping, and says, "Please, just take my half of the house for $50,000. I want out." Here is the secret that Buffett teaches. You do not have to answer the door. You can ignore him, or you can take advantage of him, but you must never, ever fall under his influence.
This brings us to the critical distinction in the book. Price is what you pay. Value is what you get. Most investors look at a stock ticker, Mr. Market's daily shouting, and assume that number tells them what the business is worth. If the line goes down, they think the business is failing. If it goes up, they think it's succeeding. Buffett says this is backward. You calculate the intrinsic value yourself using those earnings numbers we talked about, EPS and ROE. If the business is worth $100 a share and Mr. Market is depressed and offering it to you for $50, you buy. You buy aggressively. Warren loves to use a baseball analogy here. He talks about the legendary hitter Ted Williams. Williams wrote a book called The Science of Hitting, where he divided the strike zone into 77 little cells. He knew that if he swung at a ball in his sweet spot, the fat pitch, he would bat 400. If he swung at a low outside corner pitch, he would only bat 230.
In baseball, if you don't swing at a strike, the umpire calls you out. But in investing, there are no called strikes. You can stand at the plate, bat on your shoulder for days, months, even years. Mr. Market can throw pitch after pitch. General Motors at 40, Coca-Cola at 60, IBM at 100. And you can just stand there and watch them go by. You don't have to swing until you get that fat pitch, a great business, at a price far below its intrinsic value. This is why Buffettology suggests that a bear market, a recession, is actually an investor's best friend. When the rest of the world is panicking, when the news is terrible, Mr. Market is depressed. He is giving away Ferraris for the price of Fords. That is when you swing. But once you connect with that ball, once you buy that perfect business at a bargain price, what do you do next? The answer might surprise you. You don't sell it when it goes up a little. You don't trade it. In fact, you do absolutely nothing. You let a different force take over, a force Einstein reportedly called the eighth wonder of the world.
That force is, of course, compound interest. It is a term that might give you flashbacks to high school math class,
But within the pages of Buffettology, it is treated as the holy grail. This is the secret sauce that takes a good investment and turns it into a dynasty. But here is the catch, and it is a big one. Compounding takes time. This approach is not about getting rich quick. It is about getting rich for sure. If you look at Warren Buffett's life, the trajectory is fascinating. People forget that he wasn't born a billionaire. He was successful in his 30s and 40s, certainly, but the astronomical wealth we associate with him today didn't explode until his later years. In fact, more than 99% of Warren Buffett's net worth was earned after his 50th birthday. Let that sink in for a moment. 99% after age 50. This is the effect of the snowball. Imagine a snowball at the top of a very long hill. You pack it tight, that's your initial investment, and you give it a nudge. At first, it picks up snow slowly. It looks small, but as it keeps rolling, the surface area grows, and it picks up more snow with every single revolution. By the time it reaches the bottom of the hill, it is an avalanche.
But for that snowball to grow, you cannot stop it to check on it. You cannot break it apart to see how it's doing. You have to let it roll. This brings us to one of the most counterintuitive lessons in Buffettology, the art of inactivity. In a world that glorifies hustle and day trading and constant movement, Buffett suggests that sitting on your hands is often the most profitable action you can take. Why? Because friction costs money. Every time you sell a stock, you interrupt the compounding process. If you sell for a profit, you have to invite the IRS to the party and pay capital gains taxes. You might pay broker fees. And then you have the stress of finding a new investment that is better than the one you just sold. Buffett's strategy is much simpler and much quieter. His favorite holding period is forever.
Think of it like gardening. If you plant a mighty oak tree, you dig the hole, you place the sapling, and you water it. And then you wait. You don't dig up the tree every Tuesday to check if the roots are growing. You don't pull it out of the ground because the weatherman says it might rain next week. If you did that, the tree would die. You have to trust the biology of the tree, just as you have to trust the economics of a consumer monopoly business. If the company has high returns on equity and no debt and a competitive advantage, it is a compounding machine. Your only job is to get out of the way and let it run. It sounds incredibly simple, doesn't it? Identify a great business, wait for a recession to buy it cheap, and then hold it for the rest of your life while the snowball gets bigger and bigger. But if the formula is so simple, why isn't everyone doing it? Why do most investors underperform the market averages? Well, it turns out that the biggest obstacle standing between you and financial freedom isn't the stock market, or the economy, or hedge funds. It is something much closer to home. It is yourself. Or, to be more precise, your temperament. You see, Warren Buffett has famously said that investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Once you have ordinary intelligence, what you need is the emotional stability to control the urges that get other people into trouble. That is the true secret revealed in Buffettology. It isn't a secret formula that requires a supercomputer to calculate. It is a test of character. Let's just take a moment to recap the pillars we have built together in this series. First, you stop looking at stocks as pieces of paper that wiggle around on a chart, and you start viewing them as fractional ownership in real businesses. Second, you hunt for consumer monopolies, those rare franchises that have a moat around them, protecting their profits from competitors.
Third, you demand excellence. You look for high returns on equity, low debt, and consistent earnings growth. And finally, you wait. You wait for the market to make a mistake and offer you that business at a price that makes sense. It sounds so logical, yet it is so hard to do because we are hardwired to run with the herd. We feel safe when we are buying what everyone else is buying, and we feel terrified when we are standing alone. But remember, the market is like a manic depressive business partner named Mr. Market. Some days he is euphoric and wants to sell you his shares for a fortune. Other days he is depressed and wants to sell them to you for pennies. The most empowering lesson from this book is simply this: the market is there to serve you, not to instruct you. It is his pocketbook, not his wisdom, that you will find useful. When he is shouting at you to sell because the sky is falling, you can close your eyes, think about the biology of your tree, and do absolutely nothing.
That is how you win, not by being smarter, but by being more disciplined. If you have enjoyed this deep dive into the mind of the Oracle of Omaha, and you want to continue building your library of wisdom, I invite you to subscribe to The Last Read. We are dedicated to unpacking the most valuable insights from the world's best books, so you don't have to read them all yourself. And, of course, if you want to master the specific calculations and see the case studies we discussed, you really should own a copy of Buffettology. I have put a link in the description below where you can pick it up. Investing is a journey that lasts a lifetime, but if you plant the right seeds today and water them with patience, the shade you sit in tomorrow will be magnificent. Until the next read, keep your emotions in check and let your money work for you.